Usually when we sit down to do one of these deep dives,
Mm,
we're looking at subtle trends. We're trying to read tea leaves, maybe spot a quiet shift that, everyone else missed.
right.
But today, today is different. We're looking at a market event that was about as subtle as a brick through a window.
That is a very, very fair description. The source material we're working with today, it's a transcript from Diversified Capital Aristocrats. They don't really mince words.
No.
They're using terms like bonkers, like abnormal, and nuts. And I mean, for once, those aren't just YouTube clickbait adjectives. They're actually statistically accurate descriptions of what went down.
We're talking about gold. And before anyone tunes out thinking, oh, shiny rocks, you really need to hear the numbers. The source points to this one specific 24-hour period where the price of gold moved by $100.
$100?
Now, in crypto, or even say with some tech stocks, a $100 move might be a Tuesday. But for gold,
It's a massive statistical outlier, a huge one. Gold is usually a glacier. I mean, it moves slowly, deliberately. A $100 move in a single day suggests a level of violence in the buying pressure that we almost never see.
and the number itself isn't even the wildest part.
No, it's the comparison. It's the context the source gives for that volume. That's what's really staggering.
This was the part that really stuck with me. They didn't just say, a lot of money moved. They compared the sheer volume required to move gold that much to the entire market cap of Bitcoin.
Which is just, I mean, take a second to really unpack that. Think about the entire Bitcoin network. Every single Satoshi and every wallet, every coin on an exchange, the whole aggregate value of that asset class.
Everything.
The source is arguing that a similar amount of capital had to flood into gold in just 24 hours to force that kind of price action.
Wow. It really puts the liquidity difference into perspective, doesn't it?
Yeah.
We often talk about Bitcoin as, digital gold, but this just shows you the sheer depth of the ocean that is the physical gold market.
Precisely. It highlights a massive liquidity disparity. If that same amount of, say, sovereign capital tried to squeeze into Bitcoin in one day, the price wouldn't just move. The chart would break.
It'd be a vertical line.
It would just be a straight line up. But the gold market is so deep, so liquid, that it absorbed that capital and still moved $100. That tells you this wasn't retail investors buying coins at the mall. This was heavy. Heavy institutional or sovereign accumulation.
And that leads us to the core mission of this deep dive. We're not just analyzing a price spike here. We're unpacking a theory the source presents about energy. They seem to view the market not as a bunch of separate charts, but as, I guess, a system of connected vessels.
Right. It's a hydraulic model of finance, really. The source, and this is from their video, Gold's Insane Surge, What It Means for Crypto, they argue that money is energy. And, energy can't be created or destroyed in the short term. It just transfers.
So if gold is absorbing the energy of a supernova,
That energy has to be draining from somewhere else.
and that's where the pain comes in. But let's stick with the gold surge for just a moment longer. The source is making a pretty aggressive, forward-looking statement based on this velocity.
Right.
I mean, they're not just calling it top. They're saying this is the start of a whole repricing. They threw out numbers like $5,000, even $6,000.
That is a very aggressive call. To hit 5,000, you're talking about nearly doubling from current levels. But the logic, their logic, is based on momentum. When a train that heavy gets moving that fast, well, it doesn't stop on a dime.
Right.
They're arguing that this abnormal behavior, it signals a paradigm shift, not just a trade.
But here's the thing that I found psychologically interesting about the source. You'd think if they hold gold, and they clearly do, they'd be popping champagne. And they do say they're celebrating.
But it's a weird kind of celebration.
It is. It feels heavy.
It's the celebration paradox. It's very common among what we'd call hard money investors. The source literally says, we're celebrating it because we made the right decision, but then they immediately pivot to a warning. You got to also understand what this really means in the long run.
It's like being the only guy with a lifeboat on the Titanic. You're happy you had the boat, sure, but you're not exactly happy about why you need it.
That's the perfect analogy. If gold is skyrocketing, it usually means the underlying currency, the dollar, the euro, whatever, is failing or under some severe stress. So yeah, you make a profit in nominal terms, but the world around you is getting more expensive, more unstable.
So the surge isn't the sign of health.
No, the source is very clear on that. It's a distress flare.
This connects to the specific language they use, which we should probably define. It's not your standard Wall Street lingo. They refer to cash, to fiat currency as feed, or a reserve debt note.
Yes, and this is crucial. You have to understand this to get their whole worldview. When you hear a reserve debt note, you're hearing a very specific economic philosophy. They're reminding you that a dollar bill is a liability of the Federal Reserve. It's a debt instrument. It's a promise.
It relies on a counterparty to have value, whereas gold,
Gold is a bearer asset. It has zero counterparty risk. If you hold it in your hand, you own it. Nobody has to make good on a promise for it to be valuable. So when the source talks about swapping debt notes for actual assets, they're not just talking about a trade.
it's bigger than that.
They're talking about exiting the debt system entirely.
And according to them, this isn't just some paranoid prepper strategy anymore. This is what countries are doing.
Correct. And that brings us right back to that massive volume we talked about at the top. The source explicitly says, and I'm quoting here, countries are running into metals to save themselves.
To save themselves. That is such a dramatic way to phrase a central bank decision.
It is, but look at the behavior. The source points out that this capital, which, would normally go into projects, into infrastructure, into actual growth, is being diverted to gold.
So they're betting on survival, not growth.
Exactly. When a country invests in a project, they're betting on a better future. When they buy gold, they're hedging against a disastrous one.
They're hoarding the lifeboats instead of trying to fix the ship.
That's it. And this is where that energy transfer theory really starts to bite. If the biggest players in the room, the sovereigns, are sucking all the liquidity out to buy safety, what happens to everyone else? What happens to the stock market? To crypto?
The source says, pain.
Pain. Because liquidity is finite. The source argues the entire market is going to feel pain because that energy is being siphoned off. You can't have a booming speculative market when the foundational capital is fleeing to the bunker.
It's a liquidity drain. The whole pool is being emptied into the gold container.
And this explains why, according to them, you see other assets just stalling out while gold rips higher. In the immediate term, it's a zero-sum game. The money has to come from somewhere.
But, and this is the big but of the whole thing,
Yeah.
this situation, it's not permanent. The source has a timeline. And this is where our deep dive pivots from, doom and gloom to something that actually sounds a lot like opportunity.
Yes. The energy doesn't just stay in gold forever. The source describes a sequence of events.
They lay it out almost like a flowchart. First, gold and silver move. Then they finally slow down. And
then crypto wakes up.
the crypto spring.
Exactly, the crypto spring theory. And to really understand why this rotation would happen, you have to get into investor psychology.
Walk me through that. Because why would money go from the ultimate safety asset, gold, to arguably one of the most volatile crypto? It feels like a contradiction.
It does on the surface, but think about the why. Why did you buy gold in the first place? You did it because you were afraid of the debt note, the dollar. You wanted a hard asset, an asset outside the system. Well, once gold has had its massive run and maybe it's gotten a bit too expensive or the momentum slows, where else do you put that profit if you still don't trust the dollar?
You look for other hard assets, digital hard assets.
Exactly. The source believes that the very same anti-fiat energy that drove gold up will eventually rotate into crypto. It's a search for collateral. Once the gold trade gets crowded and starts to slow down, that capital gets restless. It looks for the next asset with a similar philosophy, but, well, more upside potential.
And the source is putting a lot of weight on this call. They explicitly mention their own history, admitting, I've been a bear for quite some time.
Which is so significant. When a perma-bear, someone who always thinks the market is about to crash, suddenly flips and says, it's time to buy, you have to pay attention, it implies the data has become so overwhelming that it forced them to change their entire stance.
They called it an early spring.
It's a great seasonal metaphor. They argue, we went through an early winter, a freeze in the markets. Now they see the thaw coming. And what's interesting is how they frame this crypto spring. It's not a long, multi-year bull run. It's a compressed window of opportunity.
This was the efficiency argument. I love the math here. They said something like, 2 to 3 months of bullish activity gives me more opportunity than 6 months of bearish opportunity.
That is a masterclass in trading efficiency. Most people feel like they have to trade every day. They grind away for 5% here, 2% there, and then often just give it all back when the market turns.
Yeah.
The source is suggesting a sniper approach. Wait for the conditions to be perfect, wait for the spring, and then make your entire year's profit in 90 days.
They use the word discharge. That they plan to discharge for the rest of the year after this window. I mean, that sounds like a lifestyle choice as much as a trading strategy.
It is. It's about recognizing that markets have seasons. You plant and you harvest in the spring and summer. You don't try to grow corn in the snow. The source is saying, don't fight the trend. When that energy rotates from gold to crypto, you ride that wave. And when the wave crashes, get out and go on vacation.
But the key trigger, the signal, is the slowdown in gold.
That's the baton pass. You have to watch the gold chart to know when to buy the crypto chart. If gold just keeps going vertical, the energy is still trapped there. It's only when gold finally cools off that the liquidity spills over.
So, okay, let's recap the mechanism. Gold moves first, drains the room. Gold pauses. Then money rotates to crypto. Crypto rallies.
That's the thesis in a nutshell.
Now, underpinning all of this, the gold buying, the crypto rotation, the fear of debt notes, there's a single rule. The source mentions it almost like a religious commandment.
I will always have more collateral than debt.
That's the one.
This is the anchor. If you take nothing else away from this deep dive, this concept is probably the most important one to grasp.
So let's define collateral in this context. Because most people hear collateral and they think of, the house they pledged to the bank for a mortgage.
Right, and in that sense, the bank really owns the collateral. The source is using the term differently. To them, collateral is an unencumbered asset. Gold in a vault that you own. Bitcoin in a cold wallet. Something you own free and clear that has intrinsic value.
And debt is, well, everything else.
Debt is your liabilities, obviously, but also, in their view, your cash. Remember, cash is a debt note. So having more collateral than debt means your net worth is stored in things that are real, not in promises.
It's basically a personal solvency test.
It is. The source argues that when the financial system feels pain, the people who get wiped out are the ones who are leveraged, the ones who owe more than they own, or the ones holding promises that end up getting broken. By holding real collateral, you insulate yourself.
It's interesting how this pattern repeats itself. The countries are buying gold to increase their collateral. The source is buying gold and crypto to increase their collateral. It's the same strategy, just on different scales.
Exactly. It's a defensive crouch. The source frames the crypto trade as a way to make money, yes. But the underlying motivation is survival. They want to own things that can't be inflated away or defaulted on.
So it's defensive positioning disguised as an aggressive trading strategy. I
Right.
like that. It explains how they can be so bullish on the price, but so bearish on the economy.
It resolves the paradox completely. They are bullish on the price of assets because they are so bearish on the value of money.
Okay, so let's bring this all together for everyone listening. We've covered a lot of ground here, from sovereign buying frenzies to trading psychology. If someone is listening to this on their commute, what's the actual mental model they should be building?
I think the first step is to stop looking at markets in isolation. Don't just stare at the Bitcoin chart and wonder why it's red. Look over at the gold chart, look at bond yields. You have to understand that these are all communicating vessels.
If the gold bucket is overflowing, the crypto bucket might be empty for a minute.
Right. Recognize the energy transfer. If you see a bonkers moving gold, understand that it is sucking the oxygen out of the room. Don't panic sell your other assets just because they're temporarily starved of liquidity.
And wait for the rotation.
Wait for the signal. If the source is correct, the real opportunity comes when the panic buying in gold finally subsides. That is your early spring.
And finally, that lifestyle philosophy. You don't have to trade all year.
No, absolutely not. Identify the window, execute your strategy, and then discharge. There is a lot of wisdom in knowing when not to play the game.
It's funny, we started this deep dive talking about a crazy market event, but the advice actually ends up being incredibly disciplined. It's not about chasing candles. It's about understanding the flow.
That's usually the case, isn't it? The market noise is chaos, but the underlying mechanics, supply, demand, liquidity, fear, they're actually quite logical if you can zoom out far enough.
Before we sign off, I just want to circle back to one thing. We talked about the celebration paradox,
Yeah.
about making money while the system strains. Is there a final thought on that?
There is, yeah. We spend a lot of time analyzing the source's strategy for the individual investor. Buy gold, then buy crypto, stay safe. It's very empowering for the individual, but I can't shake that line about the nations.
Saving themselves.
Yes, if the governments of the world, the entities that control the currencies, the laws, the armies, if they are rushing into gold to save themselves, ignoring growth to just hoard collateral, well, that implies they see something on the horizon that's much bigger than a stock market correction.
It implies they're preparing for a storm.
A very big one. So, while we can celebrate the potential for a crypto spring and the profits that might come with it, I think the listener should also ask themselves, if the captains of the ship are putting on life vests, should we be focused on upgrading our cabin, or should we be paying a little more attention to the iceberg?
That is, well, that's a sobering thought to end on. But that's why we do these deep dives, to look past the headlines and maybe see the iceberg. Thanks for listening. We'll catch you in the next one.